2:32:05 p.m., May 6, 2010. The constant hum of trading machines was swallowed by a physical silence. In less than 2 seconds, the Dow Jones dropped 300 points. By the 12th second, over 600 were gone. On the charts, green lines collapsed as if someone had cut their foundations. Mutual fund giant Waddell Reed had unleashed an automated sell order of E-mini S&P 500 futures worth $4.1 billion, opening the gates to an invisible chaos. High-frequency traders began tossing the same contracts back and forth at microsecond speed, the infamous hot potato effect. In just 14 seconds, 27,000 contracts changed hands. Across the Atlantic, a lone British trader was flooding the market with thousands of fake orders, manipulating prices before anyone could react. And in that moment, the world learned that 12 seconds were enough to snap the spine of the largest economy on Earth. Would you survive 12 seconds like this? It was just another Thursday afternoon, or so it seemed. The S&P 500, the Dow, and the Nasdaq had been moving in moderate volatility, nothing hinting at a collapse. From its Kansas headquarters, Waddell Reed managed billions for institutional clients. That day, it executed a massive sell order using an algorithm blindly programmed to dump E-mini contracts into the market without considering available liquidity or price shifts. But somewhere, thousands of miles away, a man was about to turn a technical error into a global disaster. Navinder Singh Saral, later accused of spoofing, placed over 19,000 fake orders worth $200 million, canceling them before execution to move prices. It was a high-speed chess match where each player moved invisible pieces, a war board where a single wrong move could cost entire territories of your financial freedom. How long would you last on this battlefield? Automated systems incapable of reading human panic began trading with each other. Contracts were bought and sold hundreds of times per second, inflating volumes and draining real liquidity. In minutes, solid stocks like Accenture were trading at $0.01, like buying a Manhattan apartment for $1, while others spiked to $100,000 a share, the equivalent of paying a small nation's GDP for a single stock. Picture yourself at home watching your retirement account lose half its value while you're still logging into your brokerage, or opening your app and seeing decades of savings vanish and reappear in minutes. The trading floor felt like a bunker under attack. In the chaos, a veteran trader watched his fund teeter on the edge of a collapse, decades of reputation and billions evaporating with clients calling non-stop. For a general, it would be like watching your front lines dissolve before the first shot, and here, the collapse could still get worse. Would you keep your ground or run? 3:07 p.m. Algorithms began exhausting each other's orders. The sudden lack of liquidity forced automatic adjustments. Orders were pulled, and the market found small pockets to breathe. For a moment, it looked like the drop would continue and deepen, but a wave of institutional buybacks began to surface. Investors seized liquidation prices to retake advanced positions, reversing part of the losses. In less than 20 minutes, much of the plunge was recovered. This lightning rebound became known as the flash crash. The tactic that changed everything wasn't heroic, it was mechanical. Improvised circuit breakers from certain brokers halting trades to stop the bleeding. The lesson? In chaos, even machines know when to retreat. Would you know when to turn the tide? Consequences and present threat. In the aftermath, the SEC and CFTC released a joint report naming Waddell Reed's sell order as the initial trigger and Saral's spoofing as the amplifier. By 2015, Saral pleaded guilty to market fraud and manipulation. The event led to formal circuit breaker rules and outright bans on spoofing and layering. High-frequency trading regulations followed, and the flash crash became mandatory study in finance and behavioral economics. But here's the catch. Today's automation is faster, more interconnected, and heavily reliant on AI. In 2021, a coding glitch at a major U.S. broker caused hundreds of erroneous orders in less than a second, enough to briefly distort multiple stock prices before humans could react. The next crash could be worse and spread globally before a single trader sees it coming. That's why your defense plan must be ready before the first shot is fired. If it started right now, would you be ready? The flash crash proved that in fast, interconnected markets, risk management isn't optional, it's survival. If you trade, set clear protocols, automatic stop losses, diversification, and above all, understand that algorithms react without emotion, but also without common sense. If speed kills in the markets, it can destroy in your life too. When was the last time you stopped to think before acting? Apply this now. Review your stops, know the average volume of your asset, and never rely on a single automated execution. The mantra, speed without control, is an open invitation to collapse in the markets and in your life. Comment, I don't trade my financial freedom. Share this with someone still fighting this invisible war. The next crash won't announce itself. When it comes, you'll either be protected or watch your portfolio evaporate on the screen. When the next second comes, you'll either be ready or find out too late that you've already lost. And when that moment arrives, there's no replay. When the next second comes, will you be ready or already lost forever?